So topic of our panel today is financing your business expansion in the context of today's financial landscape. So obviously we just talked about affiliating with institutional capital partners and private equity, but there's quite a few people that are funding their growth in a different manner, whether that's debt or other options. So excited to be here with this incredible group of people that are going to help educate us on all the options there are as far as financing our business. So to my left here is Mike Montgomery. Mike is a Senior Vice President in Live Oak Specialty Finance Division, providing solutions to lower to middle market healthcare companies looking for debt capital for their M&A strategies. Live Oak's Health Group focuses on physician practice management platforms with a concentration in the dental service organization. I've had the pleasure of working on some projects with Mike. And Mike currently works with groups ranging in 3 to 60 million in EBITDA. Previously, he worked with Live Oak's healthcare team as a senior loan officer, where he developed business strategies in the DSO lending and providing structured loans to doctors and dentists for expansion, construction, commercial real estate, and various other business purposes. Mike joined the Live Oak team in the early 2013 after 7 years with SunTrust Bank, and has a business degree in finance from University of North Carolina. So thanks for being here with us.
Thanks for having me.
Yeah. So Mark, nice to see you, Mark. Mark Flock is an executive and partnership consultant for Polaris Healthcare. Polaris Healthcare is a strategic consulting and M&A advisory firm that helps group dental practice owners and clinicians unlock potential and create generational wealth. We love that. They're an outcomes-oriented organization with a bias towards action and strategy. Previously, Mark spent 10 years in healthcare finance, leading teams and working with doctors looking to acquire practices, buy-ins and buyouts, starting up practices, and financing real estate. Mark worked primarily with early-stage clients up to 20 million in collections. He's also spent 2 years educating DSO clients and supporting financing their businesses. While at PNC Bank, he was also Women in Business Advocate, so thank you for that, Mark, and a regional leader for people with disabilities. He serves on the board of directors for Ohio Business Week Foundation, where he helps high school students learn about becoming entrepreneurs and business leaders in their communities. And I have a client for you, being my 18-year-old son. So thanks for being here, Mark. Karan, thanks for being here. Karan Jolly is a managing director at E&Y's Healthcare Investment Banking Group and leads their healthcare technology practice. Karan has over 15 years of investment banking experience advising both public and private companies on mergers and acquisitions, raising capital, debt, and equity capital markets, and other strategic advisory transactions. Karan has successfully executed over 50 transactions across several healthcare verticals over his career, including dental services, healthcare IT, physician practice management, home health, and hospital outsourcing. Prior to E&Y, Karan was a senior investment banker with Kane Brothers, a division of KeyBank Capital Markets. So please welcome our panelists. All right, good stuff. Mark, we're going to pick on you first. So Tom just kind of gave this lay of the land, all the changes that have taken place in our market. No secret, very tough year last year for a lot of groups and a lot of DSOs. Can you provide an overview of the current financial landscape and how it has changed over the past 2 years?
Yeah, it's changed a lot, and I'm sure you've all experienced that a little bit. I know you guys kind of spoke about more so a lot of the statistics, so I'll kind of break it maybe more into what you experienced, why you experienced it, and possibly why you are where you are. And a lot of it had to do with your doctors looking to retire maybe in 2019, 2020, and then COVID hit, something you couldn't affect. You know, most dentistry is, recession-proof to some degree, but not COVID-proof. So we kind of saw that unfortunately happen. Businesses were shut down for 2 months, and then they had a choice in 2021 to sell their business, most likely at a discount. And there's a lot of stalled M&A work from 2020 just being shut down, with financing being shut down from most banks, that you saw a feeding frenzy of acquisitions in 2021 and 2022. Speed forward to 2023, you saw, kind of like I said, inflation, interest rates continue to rise, no different than the housing market. Same thing with business loans in the banking space as well. And then you had a decision: do I want to pay an extra 400 basis points for lending, which is roughly about how much it increased over that period of time, or do I want to just focus on same-store growth? So it started to become a pivot point where things started to slow down, and we saw that as well. We had a lot of clients come to us from a consulting standpoint, where it's, hey, do I really have to pay 9, 10%, on a loan at this point in time? And it just depends on what you want to build. And so we focus a lot with clients on, same-store growth a lot of times, and it's also about their journey in a lot of cases. So a lot happened. That's kind of the why behind it a little bit, and why it transposed, but we're kind of seeing things speeding up. Banks, as Mike would say, have been open the whole time. Dentistry is a hot area for banks to lend to, so don't shy away from that. It's just banks tightened their grips a little bit on who they would lend to during those cases, and some of them shut down in 2020 and slowly phased back in 2021 even in some cases. So focusing on your practice and your EBITDA margin and having good books, so you can present yourself to a bank was kind of the key thing to continue providing lending during those tough years.
Perfect, thanks. Mike?
And I'll say it's certainly been an interesting past couple of years. I've been in banking for a little over 20 years now, and for the first time in that period, we've seen interest rates at an all-time high. So for some of y'all in practice, it's the first time you've seen it at its peak as well. To Mark's point, 2020 really kicked a lot of this off. The banks came out with the PPP program to help out businesses like yours, but it came at a cost, right? So that's one of the many reasons inflation is where it is now. I think we saw every business deal with that last year. And a big thing that happened last year that I never thought I would see, I think back to one of my favorite Christmas movies, It's a Wonderful Life. We actually had runs on some of the banks. And it really started with Silicon Valley Bank. They had an over-concentration of venture banking clients, so more kind of tech starts that didn't necessarily cash flow. They needed a lot of cash, and they would burn through it quick. They started doing a run on the bank, took a lot of money out of the banks, and it actually caused some of these banks to fail because they were too oversaturated. So really I'd say in Q2 of last year, you saw the banks pull way back. We saw M&A drop off quite a bit. And really for the last part of 23, you saw a lot of banks focus on balance sheet growth. And I'll give you a really, it's almost an insane stat to me. In the past 2 years, banks have lost about $1 trillion off their balance sheets, which equates to about 7% of all cash in banks. So that's really the focus banks are doing now. They're making sure the balance sheets are strong so they can lend again. That's kind of where we are, but I'm excited to share a little bit, I think, where we're going. We're looking at a really positive spot.
Perfect.
Yeah, I would agree with everything that Mike and Mark said. The only thing I would add is that, ultimately, credit markets, like any other market, go through cycles. We went through this 10-year period, right, for the better part of last decade, where rates were historically low, which led to record deal activity, M&A activity, credit activity. And at some point, this had to slow down, right? This velocity of deal making had to come down. I think the slowdown was inevitable, obviously driven by inflation and the rate hikes eventually. I think another factor that was at play was, I think some of the banks were maybe oversaturated when it comes to lending to dental on the back of all this M&A activity, and certainly with some of the soft performance that we saw with larger DSOs as it relates to them being over-levered. I think they face some challenges when it comes to supply inflation with labor costs, and I think overall slowdown in organic growth, which led them to trip financial covenants as well, which made, I think, lenders even more gun-shy in the light of the rising rate environment as well.
Yeah, so I think the story really ties together here where, from Tom's perspective, we're not seeing a lot of deal activity on the equity side of the house, but based on the feedback here, you all feel that the rise in interest rates, the inflation, the lack of performance has also led to a slowdown in M&A activity, even from a debt perspective. Is that fair?
Yeah, I think all that contributes to, especially where leverage is today. And I actually did a little bit of research this morning on Live Oak's portfolio. We've got about 25 DSOs that we work with, ranging anywhere, like Ellie mentioned, 3 to 60 million in EBITDA. We had, in the second half of last year, about 60 transactions where our groups were doing purchases, and the multiples were up from what we've seen in the past. I think the average was about 6.2, and probably about a year before, it was probably about 5.8 or so. And so I think a lot of that has to do with inflation and everything else that we were talking about. So that's one thing that the banks are trying to figure out right now is where do we want to lend to from a leverage standpoint, especially if multiples are being compressed on that sell side. You don't want to go in and overpay for something and then not be able to get a nice return.
Yeah, that makes sense. And I personally know of at least 4 platforms, one on the smaller side, but 3 national platforms that are in the process of divesting assets right now. And it's a tough topic to go down, but a lot of accelerated growth and in acquisitions in 2020, 2021. And then 2022 rolls around, interest rates are high, performance is not what it's supposed to be, and we're seeing the divestiture of assets. So, Mark, from your perspective, what can be done to avoid that type of situation? If someone's gone out, they acquired a bunch of practices, maybe they didn't have the integration playbook down, it was kind of just a roll-up without, the type of thought that it really requires to build a quality platform. What can be done to try to avoid that type of situation?
Yeah, it's a great question, and we see this a lot, at Polaris, and we've seen a lot of clients that are, interested in going to market right now. So we're kind of seeing, at least with, for us, we're getting busy in the M&A side of things for some of our clients, which is great to see. Doesn't mean the overall industry's back by any means, but it's starting to tick back up a little bit, at least from the clients we're working with. But what you just mentioned is, the rising cost of capital, say example, if it's $100 million of deployed capital with that DSO and rates rise, 4%, there's $4 million in that example they have to find on their P&L from an expense standpoint to get back to break even from where they were before. So, focusing on the current operations, a lot of larger groups, like I said, potentially that are divesting of assets or locations, may have used an aggregator model to grow their business. They were buying locations for sake of EBITDA to grow their multiple, but they weren't focused on same source sales or improvement. So when you buy a business, we work with every client. You don't buy a business just to buy a business. You buy a practice to grow it at the end of the day with a thought in mind and a goal in mind. So you buy $1 million practice from a revenue standpoint, your goal is to get it to 2.5 and take the EBITDA from 200,000 to hopefully 700,000. That's worth more to you, and you'll pay a higher interest rate for it because rates are higher than they were before, but you're gonna make a lot more money in the long haul if you do that correctly. If you keep it the same, that's why you can get in trouble. So we saw that with clients coming to us and say, how do I fix the situation? That's one way where we get under the hood and try to help them fix that situation. So it's your philosophy, and and that's one way of fixing it, or one way you can get in trouble pretty quick.
And not to mention the cultural impact. We just got done talking about, wanting owner doctors to be involved, roll a portion of their proceeds. I mean, there definitely is a cultural issue in helping protect the investment of the folks that you're acquiring as well. So thank you. Now, I wish we all had a crystal ball, but unfortunately we don't. But we're going to see if Mike has some psychic abilities here. What trends are you seeing in the financial landscape for 2024 and possibly beyond?
I'll start by saying this. Again, dentistry is probably one of the most resilient industries out there. For example, our bank lends to about 40 different industries, and I would say dental is our number one in terms of performance, very low default. So I'm very, very bullish on what's going to happen in the next couple of years in the dental market. Although we did have those issues last year, I think it led to banks pulling back for a little bit and kind of resetting. I'm starting to see more banks come back into the space now and actually fill in some voids that we didn't have before. It used to be really hard once you got to 3 to 5 locations, get to the point where a bank like Live Oak can help you once you're around 3-4 million EBITDA. There's now banks to help you in every stage of that growth plan, and so really excited about that. I think again, deposits is going to be number one. That's what banks are going to look for when working with you. But I think going forward, it's going to be more focused on the really strong, sophisticated groups. And I'll say, every group that I've met, everybody in this room is so much different than they were 5 years ago. I think the education in this space by all of the vendors out in this room and CareStack and Ellie and everybody else have been great. So there's a lot more sophistication than they're used to, and I think the borrowing base is a lot smarter today. I'd say most importantly, banks are going to be more focused on managing leverage, which really results in where the risk is with these. And we're seeing more and more banks kind of lending on a senior leverage standpoint around 3 times. And when I say leverage, really looking at that debt to EBITDA ratio. So how much debt do you have versus how much is that adjusted EBITDA? Typically, banks are going to lend about 3x on the senior, meaning the money that you have with that particular bank. And then from a total leverage standpoint, that would include the senior leverage plus any subordinated debt. So whether that's an equipment loan, a seller note, something like that, that's really where the banks are looking to play, is that 3-4 model. As I mentioned, a lot of these purchases are around 6.2, so there is a gap in there that you've got to look at trying to hedge with, having that clinical alignment, having the rollover equity, putting a little bit of cash down. But that's kind of where the banks are right now. I think they're going to be open. I think interest rates are stable. I don't know if they're going to decrease anytime soon, unfortunately. The Fed did meet, 2 weeks ago, and they're holding steady. We are in an election cycle, so there is a lot to do with that. But I think at least we've stopped the bleeding on interest rates. I don't think they're going up any further. Hopefully we'll start to see a decrease later this year.
Right. And Karan?
Yeah, just to add to that, right, certainly the pause in rate hikes end of last year was a step in the right direction. It helped with thawing of the credit markets, maybe remove some of the uncertainty in the markets as well. Led to the rally in the equity markets, which is obviously continuing into the new year as well. These are all kind of positive signs, and I think generally creating more optimism in the mood when it comes to investors, right? I think going forward, most economists are predicting, well, certainly expecting some rate cuts, maybe as soon as the next meeting, and maybe a couple of more. We'll see if that happens or not. When it comes to what's happening on the ground, what we're hearing is that lenders are certainly more receptive to deals now. At the same time, pricing hasn't come down yet. I think for that to happen, the rate cuts have to be put in place, but the leverage reads have ticked up a little bit, right? Because I think what happened in the last 2 years was pricing went up significantly, and then also the quantum of debt that was available went down, right? Because I think banks were just more risk averse, lenders were more risk averse. That started to pick up, right? And so I think the leverage rates that we're hearing are certainly higher. But one thing to keep an eye out on is still inflation, because if that ticks back up, then all bets are off, right? Again, so we'll see.
Yeah, great point. Mark?
Yeah, you kind of both hit the great points, and I agree with both of you guys on that. One thing that I've noticed is a shift, and I mentioned it earlier, with doctors and practice owners going from building to exit, and that philosophy, to building and maintaining or growing. So it's increasing same-store growth. We've seen that shift in the last 6 months at Polaris, which it's a very obvious shift to some degree. And the nice thing about it is, I don't want to say the nice thing, it's the unfortunate thing about it, it's forced, in my opinion, because if you look at the reimbursement rates of what's happened over the last couple of years, you look at the rise of the interest rates, you look at the rise of inflation, you look at the rise of the cost of wages with your hygiene groups, your assistants and front desk, everyone, it's all coming out of your pocket as business owners at the end of the day. So how can I make more money and present myself to my financial lender or institution so I can grow? You have to work on your existing operations, because your balance sheet might be suffering. You just got through PPP, you got the loans, now you're a full year and a half, 2 years out of those funds. It's real life, it's no longer funds given to you by the SBA or anything like that. It's operational, completely on your shoulders. So they're gonna be looking back at the last 2 to 3 years, and you're gonna have to prove yourself on why you should get that next $1.5 million or $3.5 million, or plan to buy 1 to 2 locations a year. You're gonna have to present yourself in a way to allow multiple lenders, hopefully, to approve you for it. If not, then there's an issue somewhere. And that's where you gotta focus on over the next 6 to 12 months. Yeah.
And I totally appreciate you saying that it's forced, but the reality is it's what it should have been all along, right? Because the practice teams, again, through that bottoms-up lens, they deserve to have the support, the operational excellence. And it's unfortunate that we went through this period of time where there was no focus on operational excellence or integration or technology, and we were simply aggregating a bunch of EBITDA. Yep. And they always say everything happens for a reason, and although nobody likes to divest assets, it's actually, in my humble opinion, a really good thing that it's forcing us to get back down to the basics. It's forcing us to focus on operational excellence. Because frankly, at the end of the day, the people in this room, unless if you're face-to-face with patients, and really ultimately the reason why we're all here is that patient care, they're not getting the support that they need in order to be successful. So I know this isn't an operational panel, but the painful outcome, the positive part of it is that we're getting back to doing things the right way. So that's great. Karan, I know you're very involved in implementation of technology, obviously a topic very near and dear to my heart. What role do you think technology is going to play in improving operational and financial performance, and how to better position practice owners to finance their business in 2024?
Yeah, so as you said, right, this topic is really near and dear to my heart. This is what I do on a regular basis. But I know you covered some of these topics in the previous session as well, so I'll try to be brief here. Needless to say, technology can play a massive role, right, in terms of improving financial and operational performance of practices. There are several areas that we see where you can really move the needle quite a bit. I think one area is around maybe investment in the more modern cloud-based practice management solutions, like CareStack. I want to give them the shout out right here. Versus using some of the older on-premise legacy solutions that simply haven't kept up with the times, right? They're dated, right? They cannot do a good job with helping practices in running operations. I think there's obvious benefits to all the cloud-based platforms, right? They're certainly more user-friendly. I think there's a lower total cost of ownership with cloud-based solutions. There's certainly flexibility in being able to manage multi-location practices that is not always available with on-prem solutions. There's more data sharing, right, that comes with cloud-based solutions. And then certainly their ability to integrate into the broader ecosystem of solutions like patient engagement, like analytics and business intelligence is superior to anything that's on-prem. So I think that's certainly one area where we see a big investment that's happening, right, or shift that's happening from on-prem to cloud. The next one would be patient engagement, which I think broadly encompasses a whole suite of solutions. From the front end, it could be tools that help with patient scheduling, right, with appointment reminders. It could be all of the demand generation marketing tools, right? Could be SEO, SEM optimization. And then on the back end, it is just payment reminders, and then also referral management and surveys, right? All of which are critical, I think, to what Mark was saying, right, in terms of retaining your existing patients, and then certainly driving new patients, right, to come to your practice. All of this is absolutely important to drive same-store sales growth, which is an area of huge focus, even for lenders right now. It's not just about multiple arbitrage anymore, right? It's more about, can you drive revenue growth, increase profitability? So all of these products, I think, play a huge role in doing some of that. The third one I would call out is, I think, just the business intelligence and analytics tools that help practices or kind of provide real-time insight into the practice operations, monitoring performance, KPIs, financial performance. Again, really important, right, to be able to see what's happening in real time versus maybe after the fact, and being able to improve patient care, right, operational performance, which ultimately falls to the bottom line for each practice. A couple of other areas would be just other innovation that's happening around digital imaging, right, charting, also around rev cycle operations, maybe just more effectively doing the blend of what's done in-house versus what's outsourced to specialized vendors, right, because they can do a better job. So I think ultimately sophisticated tech infrastructure is key in terms of improving financial operational performance and ultimately in driving lending decisions as well, right? I think lenders have become sophisticated enough to see, can practices produce P&Ls, certain, like a week, 2 weeks after the month closes, right? Can they provide real insight into how many doctor days there were, right? What's the hygiene mix, right? What's the specialty mix, right? All of that. So I think that's becoming more and more important.
Yeah, that makes a lot of sense, especially when you're leveraging against the EBITDA, right? So gaining those efficiencies, not having to deploy more marketing dollars for new patient acquisition, reactivating your existing patients. There's so many little fine details, but all of those things really help to P&L optimization and therefore being able to finance your business more readily. So on that note, Mike, what are the top 5 criteria for gaining approval for financing when expanding your business? And I'm asking this very specifically because I have a lot of clients that I've recently either brought to you or other institutions, right, with a lot of excitement to set up a debt facility to pursue some growth. And a lot of times, the answer ends up being no. So what are the top 5 criteria?
The 5 for me are pretty easy, and it does encompass quite a bit, but this is kind of the common denominator we look for in a client, in a partner, and in really successful groups. And it's one that if you don't have one of these 5, you at least can put that blueprint together to get there. So it's always a fun conversation for me with new groups on, if they don't have all 5, Who can we introduce them to, whether it's Mark or a Dykema or a CPA or whoever. But I'd say first and foremost, number one is culture. Does that group have a good culture? And it really starts with alignment and clinical autonomy. We look at some of the old DSOs and kind of the first generations of DSOs, and they didn't necessarily have that, right? And so there was a lot of turnover. It was hard to retain both clinical and non-clinical employees. If you're looking at buying a practice, you want to be able to give some rollover equity to those doctors so that they can ride that wave with you. And to give them the ability to make their own decisions at the practice level is so important. I heard Tom talking earlier in the last panel. It sounds to me like a lot of the private equity groups now, when they're looking to sell, these big firms are looking at culture as one of the main reasons that they get premiums. And so for us, that's kind of a non-negotiable for us is, do you have that culture in place so that you've got a great practice that your employees want to go to and your patients want to go to? I'd say number two is, what type of sophistication does your DSO have? And that starts with your team in place. What type of C-suite do you have? What do your financial reporting requirements look like? Is everything consolidated? Do you have a controller in place at the very least? Some groups are not big enough to have a CFO yet, and that's fine. We work with a lot of groups that do some fractional work, but really to look at building that team out. And I get it, it's expensive, right? These are add backs. The bank looks at them as add backs. And to us, it's more important to invest early. It's going to be less expensive than trying to go without making those investments. It's going to be a lot more expensive not to make those investments down the road. The same for operations. You got to make sure you have the right operations people, HR, and so that's really what we look for is, do you have the right tools in place to continue to grow? And that's the same for your software implementation as well. Number three is really your historical trends. Have you practiced or bought practices in the past, and how were you able to integrate them into the platform, and how have you grown those from a same-store growth standpoint? The same with how are you able to manage expenses on that. So we look at all those things. We like to look at the track record, and gives us a lot of comfort. So typically for us, we kind of come in 10 locations or so, because that gives us enough information to get comfortable with how you've been able to run your business. Number four is really having that business plan and that vision. Oftentimes we'll ask folks, where's the business going to be in 3 years? And they're not quite sure. We kind of want to see it mapped out in the business plan. We want to see it modeled out. We understand changes are going to be made over time, but we want to see those and work with you as that's happening. We want to see what the capital plan is. What do you look to purchase in the next 12 months and why? And so having that solid plan in place is paramount for us. And then I think the last thing is really what we talked about earlier is really mitigating risk through the leverage of your practices. Some of the strongest groups that I've talked with, I asked them, I said, do you have a limitation to what you'll pay for any one practice? And most of them say yes. And if there is a reason to pay a little bit more for one, they've got to make a pretty clear reason why, and the ability to kind of, if they're buying for 6X and we're only lending the 3X, how they're going to bridge that gap. So having a plan in place there. Those are really the five main things that we like to look at. And again, if it's something that you don't have today, Mark's one of the perfect people in the room to talk to about that.
Awesome. Very good. Thank you so much, Mike. Mark, what avenues are there to fund growth? And I get asked this question all the time. Is it better to fund my growth off the balance sheets, or is it better to pursue a debt facility, for example?
Yeah, that's a great question, and without being a licensed CPA to really go into detail about the balance sheet aspect, got to be somewhat careful on how I would say that. But from a consulting standpoint, I would say it depends. And the reason why I say it depends, it all depends on a lot of different factors. One, where the current interest rates are. I mean, if it's 20% and you have excess cash on your balance sheet, it may make sense to deploy cash on your balance sheet. The next part is, do I have excess cash on your balance sheet? It depends on what you define as excess cash. So I would typically define that, and it depends on the business, how fast they're growing, where they want to get to, the current size, the potential future state, but general rule of thumb might be in excess to 2 times overhead. So keep in mind, the amount, when I say excess, is above that, not what that number is. So you have to be able to operate at least a minimum of two months. You saw what happened with COVID. That's a good reason why you got to have that on hand to deploy if you do need it and you don't get PPP money or anything else down the road. Or even on top of that, you want to have excess cash because you never know what's going to happen, but also you may have other needs down the road, like equipment or an expansion project. If a bank declines you for debt-funded funds, it's probably an issue of the things that he mentioned that you need to work on over the next 6 months. And I'd ask the question, do you really need to buy this business, and why are you buying it now if a bank's not willing to fund it? So maybe you shouldn't be using the balance sheet because you're already tight with respect to what the bank feels at the end of the day. So I say it depends. I would typically advocate for bank financed. Main reason, like I said, you can deploy cash. Ideally, you'd get some type of guidance line or growth facility in writing with your lender. And essentially what that is it's a guarantee, I don't say guarantee, but it's an upfront written approval on what you can go out and target and buy or create as far as de novos. Almost all of our clients we work with in getting those, because it's like going to the grocery store with your credit card, but you don't know the credit limit, and you're sitting there with the groceries and you ask the cashier, okay, I got to call the bank to see if they'll approve this. And then you wait and you wait and you wait, and the line gets bigger, and they say, okay, we're good. Well, you could have avoided that because you already know your credit limit. You walk up, you pay, you walk out. Simple analogy to keep things quick, but that's how it would be like to have a guidance line or growth facility as you're looking to buy or purchase. So you know the amount, it fits in between the box, you go deploy it quickly, and that's how a lot of these larger DSOs are moving quick on deals, or they have private equity money as well. But there's ways you can do that once you get to the middle space, and we help clients do so.
Yeah, so what I'm hearing you say, it really depends. Take
Correct.
a look at interest rates, how much cash you have on the balance sheets, and make the decision there. But Mike, I've been in a situation where I've worked with a phenomenal founder. They've grown pretty exclusively off the balance sheets. And going back to the 5 points and criteria, the EBITDA was there, but the cash flow wasn't there because of that growth. So at what point is it right to reach out to, a Karan, a Mark, or a Mike to say, hey, I've done a good job, I've had plenty of cash on the balance sheets, but not wait so long to where you've depleted all the cash and now you can't even set up a debt facility?
Yeah, I think it's important to reach out and talk to your banker, talk to your CPA, whoever it is, and really kind of reset your basis a little bit. We can actually take a look and give you some feedback on where you need to be from a cash flow standpoint and where the cash on the balance sheet needs to be. We work with a lot of great folks in this industry. Some of you are in this room. I see out there now some fractional CFOs and financial consultants and things like that. But what we really like to do is at least have kind of a consulting call with you as a bank, and kind of set that blueprint with you, and then kind of give you maybe 2 or 3 recommendations, so that you can go out, talk to some different folks, and kind of get your ducks in a row so that maybe 6 months from now, we can get together and partner and give you some lending capital.
Perfect. So again, I think the message and the takeaway here is don't wait until it's too late, whatever the scenario is. So thank you for that, Mike. So Karan, there's so many lenders out there with so many options, but not every option makes sense for long-term growth. How can founders and practice leaders choose the right credit product for their organization, and how should they go about evaluating their options?
Yeah, I mean, I think the short answer, it depends, right? As Mark said, right? I think it depends on the stage of the business or where you are or what stage of the evolution you are at, what's the scale of the business. But generally speaking, in terms of capital options, you've got really two options, right? It's either debt or equity, right? And they come in different flavors, right? When it comes to debt, there's certain advantages. When it comes to bank debt, it is certainly the cheapest, right? Or used to be the cheapest. I think it still is. It is the least dilutive, but it does come with more oversight, with covenants, right? With limited flexibility as well. You got to pay it back in 3 to 5 years, right? You got to have or demonstrate the interest coverage or the ability to pay back the premium, the principal, right? In 3 to 5 years. So that's kind of one option, right? Going down the bank debt route. If that's not available, right, you've got other forms of debt, like junior debt, which could be mezzanine debt, which tends to be more expensive. But in this market, the spread between bank debt and even like direct lender debt and mezzanine debt is not that far off, right? So that's certainly an option for practices that have, or groups that have near-term growth opportunities, and that debt capacity is not available from lenders. With junior debt, right, slightly more expensive, does require some giving up some equity, so it comes with some dilution as well. But it does have a longer horizon, so there's more flexibility in terms of when you need to pay it back. So certainly advantages, right? And if neither of those are available, right, then you've got the equity option, right, which is the most expensive for sure. Requires, I guess, investment from either a VC or private equity investor. The business has to be of scale. I think the advantages are it has the most flexibility. It's the most patient capital. So these investors will come alongside you and help you scale the business from where you are right now to a much larger business, right? So I think that's the advantage, but it ultimately depends on where you are.
Right. Sounds good. Thank you, Karan. And if you guys have more questions around the different types of equity, please reach out to Mark. The various options around debt facility, Mike has always served as an incredible resource for me, and I know many others in the industry. So thank you so much for your time.